Let's talk about the Bank of Canada and what that means for your mortgages. My name's Jesse Malik and I work with Indie Mortgages. Every time the Bank of Canada has a rate announcement, I get a ton of questions. So let's break it down. So really the Bank of Canada's, their job is to ensure that inflation stays at around 2%. And they really do this just by controlling monetary policy. So what that means is they're either going to change the rates and make it go up, or they're going to make it down. Sometimes they leave it the same. They really determine that based on how inflation is going. So if inflation is up like it was back in like 2022, we saw like 9% inflation rates, the Bank of Canada is going to aggressively increase rates. So that way there's less money in the market because people can't go borrow money as easily. It's a little more expensive. So that way that takes a little bit of money out and there's less demand, causing inflation to decrease. If inflation is down around that 2%, then the Bank of Canada is going to look and say, hey, we want to get the economy going a little bit more. We want to have unemployment down. We want people to make more money. So we're going to decrease those interest rates so that way it's a little bit easier for businesses to borrow money, homeowners to borrow money, that kind of stuff. And then what they do is they then reinvest it into the economy, creating new jobs and new opportunities, right? So what does this really mean for your mortgage? Well, if you have a fixed rate mortgage, anytime the Bank of Canada does a rate announcement, whether it's up, down, or the same, it's not going to affect your mortgage at all. You have a fixed rate, it's locked in till that end of the term. So whether you took a 3-year or a 5-year, which are the two common terms, there are 1, 2, and 3 years as well, or 1, 2, and 4 years as well. But mostly people elect the 3 or the 5-year. Once you've picked a fixed term, nothing's going to change till that end of that term. After that 5 years, you can then renew and hopefully rates are lower. If you have a variable rate mortgage, that's where it becomes important. If rates were to go up, that actually means that your mortgage rate's going to go up and you're likely going to be paying a higher mortgage payment unless you have one that's kind of like a static payment and it just adjusts the principal and interest portions. But for the most part, if rates go up, your mortgage payment's going to go up. If rates go down, like we're seeing lately, your mortgage payment's going to go down, which is actually a benefit to you. So really that only affects variable rates. And I see a lot in the media too where they talk about, well, the Bank of Canada rate is this. I think it's about 2 something right now. So what they're looking at is what the overnight lending rate is. And I get a lot of questions saying, well, I saw that rates were 2%. Can I get that rate? And that's actually not the rate that clients would get. That's just the rate that the bank can borrow money from the Bank of Canada. So think your TDs, your Scotias, those kind of banks borrowing money from the Bank of Canada. They're obviously not going to lend it out to you at cost. They want to make some money on it. So they increase the rate on that. And that's how they make their profits. If you have any questions about these rates or what rate would be best for you, feel free to reach out. My contact info is going to be in the comments. But my name's Jesse Malik. My phone number is 519-870-3503. Have a great day.